That rand still trading around that 690 level this morning, and it looks like it took some heart from that current account data that came out of the quarterly bulletin yesterday. Current account deficit at its lowest in 7 years, 0.6% of GDP.
Yes, good morning, Stephen. That 690 is proving quite sticky. If we breach that to the downside, then we're looking at levels pretty quickly down to kind of 680. But at the moment, it seems to be providing a pretty stubborn floor. Yeah, we're going to be watching that level very, very closely. In terms of the current account deficit, was encouraging, but I think it's important to mention that although last year our current account narrowed quite nicely, we are going to probably see the current account deficit starting to widen back out again over the forthcoming year. And I say that for a number of reasons. First and foremost, we have the lagged effect of that rand appreciation that we've had over the past kind of 2 years, which will inevitably translate into a less competitive export sector. Also, it will increase the demand for imports. And then, of course, we have things like dividend payments, which are going to start picking up again as corporate South Africa starts to come back to life. And then in terms of just looking back at those exports, we've also seen monetary tightening coming through from countries like Asia and China. And of course, that monetary tightening doesn't bode well for commodity prices. And that's really what's been bolstering the export component of that current account is the relentless demand for commodities out of that Asian region. So if that starts to dry up, then as I say, the current account deficit could start to deteriorate. In addition to that, you've also starting to see the effects already in yesterday's figures of the withdrawal of capital flows out of South Africa, out of the bond market, out of the equity market. And, you know, if we look at the figures over the past couple of months as well, we're starting to see a continued outflow from our bond market. Interest rates have probably bottomed. Equity markets a little bit nervous, obviously, about surrounding all these geopolitical tensions in the MENA area, Japan and the like. So we're starting to see foreigners take some money off the table. And those portfolio flows have been a critical component of that capital account, and that's basically been financing the current account quite nicely. But going forward, we expect the current account to deteriorate, as I say, and then in addition to that, we're expecting those capital flows to dry up a little bit further. So our overall balance of payments situation currently looks good, but going forward, it might not make for very pleasant reading.
And to what extent do you think it might be made worse by Japanese investors withdrawing from the South African markets? I know there's an Uridashi bond redemption coming at the end of this week. We could see about R1 billion flowing out of the country, but there's more of that to come as well as Japanese investors take money back into Japan.
I couldn't agree with you more, Stephen. I think that's bang on the money, and I think that we are probably going to see some more of that redemption from the retail side out of Japan. And generally, the carry trade for the rand, in my opinion, is not looking that good at this stage, because we've seen an increase in volatility, and we've seen that other emerging markets are starting to tighten up their monetary stances, while the Reserve Bank is probably going to only hike rates, in our opinion, in 2012. So suddenly, from a risk-reward scenario, the carry that you are getting on the rand is not looking as attractive as it might have 6 to 12 months ago. So you could see this large-scale redemption out of Japan, but you could also see other investors in the world starting to switch out of rand-based carry trades into maybe Brazilian carry trades or Turkish lira carry trades. So all of that doesn't bode well for the rand, no.
Well, the rand at current levels, though, must give the Reserve Bank a little bit of comfort as it winds up that MPC meeting tomorrow with the decision on interest rates. Trading around R6.90. We've got that oil price, $115 a barrel, so giving a bit of relief there. We also have CPI out today. What are your expectations for that CPI heading into that rate decision tomorrow?
Well, in terms of CPI, we're expecting it to remain at 3.7% year on year. So inflation remains fairly well contained, and I think, again, you've hit the nail on the head in terms of what's probably going to keep the Reserve Bank pat for the coming months is that effect of the strong rand. The strong rand has definitely limited imported inflationary pressures. We've had the spike up in oil prices, we've had the petrol price increases, but overall inflation looks to be fairly well contained. It's likely to remain comfortably within the band for the rest of this year. So we don't think the Reserve Bank is going to be in any great hurry to tighten up its monetary stance. Of course, the risk to that is that oil prices shoot through the roof even further. That could maybe bring the hiking cycle a little bit closer. But all things being equal, we think, as I say, that the Reserve Bank will probably only hike rates in 2012. And in this week's meeting, we're expecting no change.